Hi, Tony. Good to have you back here again, and it's really been fast. 3 months passed on, relatively eventful, I think. So last quarter we discussed on our outlook, and the view was for a soft landing, more controlled inflation and peaking interest rates. So has this panned out the way that you have expected?
Yeah, so I think the data has been supportive of this soft landing view that we've had. And in fact, I would go back, to the beginning of the year. I would have said the consensus of economists were expecting a recession by the middle of 2023. Here we are at the middle of 2023, and things aren't looking recessionary right now. And I think economists around the world are revising their forecasts more out to maybe the fourth quarter of 2023 or even after that. And I do think increasingly economists are probably going to be entertaining more this view of either a soft landing or no landing type scenario, just on the back of the economic resilience we've been seeing.
So looking forward into the second half of the year, what are your expectations for the global economies and global markets? Where should our investors put their money in?
So we think that the data kind of is supportive of this theory of a rolling recession. The rolling recession is this concept where some sectors of the economy could go into a recession where other sectors of the economy are still expanding. And the data that we're seeing sectors such as the goods sector, manufacturing, and housing. They're all posting really weak data points that would be consistent if they were in a recession. But other parts of the economy, such as the service sector, that includes, hospitality, travel, leisure, entertainment, these are all still expanding. They look like they're trying to get back to sort of pre-COVID type levels of employment and capacity. And therefore, the overall economy, if we're having this type of rolling recession, means we might see some slow growth, but we might not see a recession overall in the economy. And that as investors, this implies that there should be more opportunities to invest, certainly compared to a hard landing, and that as fund managers, we should be looking for those opportunities and looking for alpha opportunities in sector by sector, what's benefiting and what's struggling.
We're getting asked a lot about the debt ceiling. It's been resolved, but how does that impact our views and our outlook going forward?
I think obviously it's very good news that the US was able to resolve their debt ceiling problem. But I'm also getting asked a lot now that the US has this capacity to issue a lot of new debt again. And the expectations is that the numbers look big. It looks like almost $1 trillion worth of new debt could be issued as the Treasury replenishes their cash balances. Could this suck out enough liquidity that it hurts the markets or the economy? For the most part, I think what we're seeing so far is that it looks like the focus of what the Treasury will be issuing is in the form of Treasury bills, and this largely has the effect of affecting bank balances and the repo markets, where a lot of the money market funds participate in. And so therefore, I think the evidence doesn't look like it's going to significantly affect the markets. And therefore, we're more focused on the fundamentals.
Talking about being positive, one of the things that we like a lot is the fixed income markets and the bond markets. We've seen investors shifted strongly into the fixed income assets, given generally the attractive yields. So where do you think the bond markets are heading, and is this something that we continue to really like? Yeah.
Right. I still think the biggest issue is it does look like central banks around the world are pretty much close to being done with interest rate hikes. The US Fed may have another rate hike or two. ECB looks like they probably have a couple more. But for the most part, compared to what we've gone through, we're at the tail end of this. And that implies that when we see these attractive yields in fixed income, that we can be more confident it's going to accrue to us over the coming year. And the yields look attractive, right? In treasuries, we're seeing 3.75 to 4% type yields, depending on your tenure. The credit spreads for even really high grade bond credits are in the neighborhood of 1.5%, and that implies even if you're staying in really safe fixed income, you can get 5% plus type yields. In a world where there's so many sort of question marks, this offers really good sort of just risk-reward attractiveness, and is one of the first things we've been recommending.
Regional market trends has been really surprising. Okay, we saw the reopening of China and we thought that would be an interesting trend, but generally the market disappointed in the last quarter. Why did that happen? And what do you expect going forward?
Yeah, the China reopening has been a disappointing trend. And, I know our team a couple of months ago, we were saying it's just not panning out like we were hoping for. And we've paused our recommendations on China. The story is complicated. Obviously, the initial rounds of reopening was held back as China went from essentially being COVID naive to herd immunity in a couple of months. And then even as they got past that, it seemed like the expansion was slower than expected, but we do think with time that this reopening benefits will accrue. And we also think that China has very low inflation, and that's going to give them more policy options in the second half of the year. So we're not really completely concerned, but we are sort of waiting for it to come together better.
What are your thoughts on the North Asian markets? Taiwan, Korea, and Japan kind of surprised on the upside. In the event of a shallow global slowdown, can these markets surprise on the upside?
They have been surprising on the upside, and in line with our view of a global resilient economy, then I think it allows us to focus on where the opportunities may be. In particular, we continue to highlight that we like Taiwan as they will be one of the beneficiaries of this big AI theme and all the hardware that's needed to support it. And also, we've been highlighting in Japan that the story there is coming together well as their economic data has been resilient, and also the fact that they're increasingly getting back on the path of being more shareholder focused, improving ROEs of the corporates, and we're seeing that overall earnings strength look fairly stable in Japan.
Coming closer to home, what about Singapore and our ASEAN neighbours? Are they set to mirror the China trends? And what's your views going forward?
Yeah, so we continue to overweight ASEAN. We like how ASEAN has a nice benefit from having a stable domestic economy, and when there's question marks about the global economy, ASEAN's economies can look a bit more stable since they have such big populations that support their economies. And then additionally, what you're also getting throughout ASEAN is this additional investment effect that's coming from global manufacturers wanting to diversify from not being solely dependent on China. And we think these themes are going to be good ones for ASEAN in the periods to come. Currently, we're overweight Singapore and Malaysia, where we see attractive valuations and stable outlook.
So I think what's very material in the region, both North Asia and Southeast Asia, has been the currencies. So what's the views on the currencies, given there's a likely delay in the US rate cuts? Will dollar continue to remain strong versus these Asian currencies? And how would that play a role in terms of our outlook and views?
Yeah, so it's been a complicated year for currencies. We started the year with the US dollar weakening and this view that the Fed would cut rates. And then that reversed in the second quarter where the US dollar has been strong. And I think it's even more in line with our view of a sort of resilient economy, and a soft landing implies we don't necessarily get a lot of rate cuts. And on the back of that, then I do think there's, especially in the near term, some underlying strength in the US dollar. And Asian currencies, part of their weakness is that they just don't have the inflation problems that the developed markets are having, and therefore they don't have to be really tight on their monetary policies, and therefore you're getting this currency differential. So in the near term, I think those trends probably continue a little bit more. But overall, as we sort of think on a sort of multi-quarter basis, we're kind of thinking that we're probably more in a period where things end up being a little bit more range-bound by the end of the year.
And there seems to be a lot of opportunities emerging in them. Yeah. Thanks, Tony.
Thank you.